Welcome to the Deep Dive. We take a whole stack of the latest articles, research, insights, and, well, we pull out the most important bits to get you informed, fast. Our mission today, cut through that noise. We want to expose a kind of common thread, something weaving through big economic shifts, market trends, even your personal life. It's all about this subtle, sometimes not so subtle, redefinition of boundaries and expectations.
Exactly. It's been a busy week, hasn't it? Major legislative changes, shifting market feelings, some really fascinating stuff in tech and personal finance. We'll connect those dots for you, show you not just what's happening, but why it really matters and, how these shifts might play into your own decision.
Right. We're going to kick things off with some big news out of Washington, specifically the recently signed One Big Beautiful Bill Act. This is significant legislation, touches everything really from your taxes to federal spending. So let's dive into what it means short-term and long-term.
Yeah, and one really insightful thing about this bill, it's not just how broad it is, but how it kind of subtly shifts the ground for individual taxpayers. It makes several key parts of the Tax Cuts and Jobs Act of 2017 permanent. You remember that one, the TCJA?
Oh yeah, the big overhaul from a few years back.
Right. So this means those lower tax brackets, the revised income levels, they stick around. For instance, maybe you were expecting to pay 25% on certain income. Well, you might keep paying 22%.
Okay, that sounds like some welcome stability for a lot of people. And I understand the standard deduction, which, is how most Americans lower their taxable income. That's seeing some big changes too.
Yes, absolutely. And making the standard deduction permanent, that's really impactful. It just simplifies things for most people filing taxes. It nearly doubled under TCJA, remember, and now it gets another bump, an extra $750 for individuals, $1,500 for married couples, $1,125 for head of household. That starts in the 2025 tax year.
Wow.
And it's significant because, about 90% of federal taxpayers use the standard deduction.
90%, yeah, that's huge.
Yeah.
Now, this bill also brings in some new deductions, right? Temporary ones through 2028. Could be really interesting for specific workers. Tell us about those.
Absolutely. So if you're a tipped worker, think restaurant servers, drivers, you could potentially deduct up to $25,000 in qualified tips.
Okay.
And for hourly workers putting in overtime, there's a new deduction. It's above the line, up to $12,500 for those overtime premium payments. There's also one for interest on auto loans, up to $10,000. But the catch is the vehicle has to have final assembly in the U.S., and this one phases out if you earn more. So for you listening, it means if you're in these kinds of jobs, it's definitely worth checking if you qualify. Could be real savings there.
Right, good advice. And what about retirees? There was a lot of chatter about Social Security and how this bill might affect their taxes.
Yeah, for taxpayers 65 and older, the Big Beautiful Bill gives them a $6,000 bonus deduction that runs through 2028, and that's on top of the extra standard deduction they already get. It's framed as sort of an alternative to getting rid of taxes on Social Security benefits altogether. It phases out for higher-income retirees. Devin Carroll, a financial advisor, actually modeled this. Found moderate-income couples could see maybe a $350 tax break. Even higher-income couples might owe about $620 less. So it's targeted relief, without completely changing how Social Security is taxed.
Interesting. Okay, let's step back for a second, though. While the bill offers tax relief here and there, it's also projected to add, $4 trillion to the national debt over 10 years. That's a huge number. And it brings up that critical question, doesn't it, about the country's whole fiscal path.
Indeed, it does. That balance, between tax cuts now and long-term fiscal health, that's something we really need to keep a close eye on. I mean, proponents will argue the cuts boost the economy, right? But critics point to that $4 trillion in new debt. They'll say it could limit future government spending, maybe push up interest rates, put more burden on future generations. It's that classic economic tug of war.
Yep.
And the full impact of decisions made today, well, we might not really feel them for years.
Right. Okay, so from Congress, let's look at another branch, the Supreme Court. They just made a pretty big decision affecting federal agencies. They allowed the Trump administration to move forward with these large-scale staff cuts, RIFs, reductions in force at 19 different agencies. And this is even with challenges still happening in lower courts.
Yeah, and this ruling, it kind of follows a long history, executive authority over workforce reductions. It goes back about 150 years. But Justice Ketanji Brown Jackson, she dissented pretty strongly, called it the wrong decision at the wrong moment. She even compared the action to releasing a wrecking ball.
Wow, a wrecking ball.
Yeah, highlighting just how disruptive this could be for how these agencies actually function. It really shows that tension between executive power and, the stability of government institutions.
And then, in another really significant move, kind of upending a 70-year interpretation of the tax code, the IRS, they stated in a court filing that churches can now endorse political candidates to their congregations without risking their tax-exempt status.
Yeah, that's right. It came up as part of settling a lawsuit. The IRS clarified, and I'm quoting loosely here, that communications from a church to its congregation during religious services through their usual channels about matters of faith. Well, that doesn't violate the Johnson Amendment.
The Johnson Amendment. That's
Yeah.
the 1954 law, right, that barred tax-exempt groups, including churches, from getting involved in political campaigns.
Exactly. So this is a major reinterpretation. It effectively redraws that boundary, that line between religious institutions and political endorsements. A really big shift.
Okay, definitely a lot happening on the policy front. Let's shift our focus now. Let's talk global trade market dynamics, because tariffs are back in the headlines, big time. President Trump announced a firm August 1st deadline for new tariffs. 14 countries, rates as high as 40%.
Yeah.
Plus a new 50% tariff on copper imports. And he even hinted at maybe 200% on pharmaceutical imports.
It's fascinating, though, how the market reacted initially, or maybe how it didn't react. Despite these really steep announcements, U.S. stock markets were, well, relatively calm. Analysts are suggesting investors aren't really panicking. Maybe they think the tariffs will get softened or delayed, part of negotiations. Copper prices, though, that was a different story. They soared 13% right after the announcement. Best day since 1989 for copper. A direct reaction to that specific tariff.
Right, targeted impact there. But there's also been so much discussion, hasn't there, about whether these tariffs will actually cause inflation. What's the latest thinking on that, especially since we're hearing conflicting things?
Yeah, it's a mixed bag. The New York Fed's June survey, it actually showed inflation expectations for the next year drifting back down to where they were before the tariff talk, holding steady around 3%.
Interesting.
And then there's a new report from the Council of Economic Advisors, the CEA. They advise the president. They found that prices for imported goods have actually fallen this year, which directly contradicts the idea that tariffs automatically mean inflation. Stephen Miran, the CEA chair, he even used this really strong analogy, liken the odds of tariff-fueled inflation to a meteorite striking Earth, basically saying it's super unlikely.
A meteorite striking Earth. Okay, that's memorable. But stepping back, like you said, not everyone buys that optimistic view, right? Mark Mahaney at Evercore ISI, for instance, he thinks consumers will eventually eat some of these higher costs. And that could really squeeze smaller companies, the ones working on thin margins.
Right, which raises the question, doesn't it? Will this disinflationary impulse, this downward pressure on prices from imports, will that continue? Or is there just a lag? Will we see the impact later as tariffs ripple through the supply chain? And the CE report itself, they did acknowledge their analysis doesn't really account for what might have happened without the tariffs. So yeah, it's complex. Different experts see it differently.
Definitely complex. And how does all this global economic activity, these trade tensions, how does it affect the U.S. dollar? That's so key for everything, trade, investment.
Well, the U.S. dollar index that measures the dollar against 6 other major currencies, it's had its worst first half of the year since 1973, fallen almost 11%.
Wow, since 73.
Yeah. And the consensus seems to be that this trend will likely continue. You've got factors like potential Fed rate cuts coming, international investors hedging more, plus the Trump administration seems to implicitly favor a weaker dollar, to help exports. Very few people on Wall Street seem to expect the dollar to strengthen much anytime soon. It really signals a broad shift in global currency dynamics.
Okay, so those are the big macro currents. Let's zoom in a bit now, look at how some individual companies are navigating all this. First up, some interesting news from Boeing. They delivered 60 planes in June. That's their highest number since late 2023.
Right, and 42 of those were 737 MAXs, which is notable, especially after that door plug incident back in January.
Yeah.
They handed over 150 planes total in the second quarter. That's actually their best Q2 since 2018. Before the 2 MAX crashes that led to the grounding and that whole multi-year crisis, CEO Kelly Ortberg seems really focused on stabilizing production, increasing output. It looks like a serious effort towards operational recovery, rebuilding trust, getting efficiency back up.
Good signs for them, perhaps.
Yeah.
Now, let's talk Elon Musk. He's been making waves again, hasn't he? He publicly told Dan Ives, the Wedbush analyst, to shut up on X. This was after Ives suggested some governance changes for Tesla's board.
Yeah, things like a new pay package, giving Musk 25% voting control, but also putting guardrails on his time at Tesla, and adding oversight on political endeavors.
Right.
And I's comments came right after Tesla's stock dropped almost 7%. That was when Musk announced he was starting a new political party, the America Party.
Mm.
Since then, analysts like William Blair have downgraded Tesla. They see Musk's political stuff as a major distraction, especially now, at a critical time for the business. This isn't just about a stock dip, though. It's a really interesting test case, isn't it? About that whole cult of personality and leadership. It really makes you ask, can a company keep its core business on track when its leader's public identity gets so tangled up with outside political ventures? It almost creates a new kind of risk for investors.
Yeah, a unique kind of systemic risk. And Tesla's stock is down about 25% this year already, illustrating that impact.
Exactly.
And speaking of X, the platform itself, it's caught up in a legal fight over censorship with the Indian government. Reports say India ordered over 2,000 accounts blocked, including Reuters.
Yeah, and this whole situation just throws a spotlight on those really complex challenges around free speech online, global tech governance, especially given Musk calls himself a free speech absolutist and made all those changes to content moderation after buying Twitter. This fight with a sovereign government really highlights that tension between platform ideals and, well, geopolitical realities. It's definitely something to watch.
Absolutely. Okay, let's shift gears again. Crypto world. Anthony Pompliano, CEO of Professional Capital Management, he signed a $1 billion SPAC deal to create a new Bitcoin treasury company. And we have an analyst from Evercore ISI, Rich Ross, predicting Bitcoin is coiled to break out to $170,000.
Wow. Yeah, it's all part of this broader crypto push, as Charles Payne at Fox Business called it, where the potential for crypto and blockchain seems, unlimited.
And just for context, that SPAC, the Special Purpose Acquisition Company, it's basically a shell company that raises money just to buy an existing private company and take it public faster.
Right.
And what's maybe even more telling, even Trump Media and Technology Group filed to list a crypto blue chip ETF. That's an exchange-traded fund. It lets you invest in a basket of assets, in this case, top cryptos like Bitcoin, Ethereum, Solana, without actually owning the coins directly. It just shows that growing institutional interest, doesn't it? And the sort of increasing legitimization of crypto. It certainly seems that way, but not every tech company is soaring, right? CoreWeave, their stock quadrupled since the IPO in March, which is incredible. But Mizuho just downgraded them to neutral.
Yeah, citing extremely high volatility and the fact that the company relies really heavily on Microsoft for its revenue.
Ah, okay.
And this really highlights the risks that can come with that kind of super rapid stock growth, especially when a company's customer base is really concentrated. For investors, it's a reminder about due diligence, right? High growth can mean high risk. And it's also worth remembering, the post-IPO lockup period is ending soon. That means insiders will be able to sell their shares, which can sometimes put downward pressure on the stock price.
Good points. And looking at broader market trends, dividend yields, for S&P 500 stocks, they're near record lows, levels we haven't seen since 2000.
Yeah, largely because companies are choosing share buybacks over paying dividends more and more.
And why is that?
Well, buybacks can boost earnings per share, push the stock price up, but they don't give you that steady income stream like dividends do. It's fascinating because right now, investors don't seem to mind too much. But Jim Reed at Deutsche Bank suggests if the market hits a rough patch, investors might suddenly start missing those regular dividend checks.
Interesting perspective.
And separately, just quickly, in banking, Raymond James downgraded Wells Fargo. They argue regional banks might have more upside now after the big banks had such a strong run. HSBC also took a more cautious stance on the giants, downgrading JP Morgan, Bank of America, Goldman Sachs. So maybe a shift in preferences there too.
Okay, lots of moving parts in the markets. Now let's bring this closer to home. How might these big economic social trends actually show up in your daily life? We've heard about this phenomenon called revenge savings, a big shift apparently, from splurging after the pandemic to saving more actively. And something like 44% of Americans are supposedly doing what's called vibe-based budgeting, adjusting their money habits based on how they feel about the economy.
Yeah, and what really stands out is the psychology behind it, right? Is feelings of anxiety, rising prices, worries about a recession that are driving this change. But financial experts stress that while feeling anxious is normal, saving should really be intentional, not just driven by emotion. They recommend reverse budgeting, where you prioritize putting money aside for savings goals first. Then you cover necessary expenses, and then you see what's left for fun money.
Right.
So for you listening, that can mean setting up automatic transfers to your savings right when you get paid. Make sure those goals get funded before you're tempted to spend elsewhere.
So a key takeaway for you is really understanding your money temperature, right?
Yeah.
Income, your expenses. And then setting up separate accounts for different goals makes sense. Maybe a high yield savings for that emergency fund, 3 to 6 months of expenses, your 401k or IRA for retirement, a 529 for education, perhaps.
Exactly. And if we put this into the context of smart, long-term planning, a really critical insight is to try and periodically increase your savings rate, even just by a small percentage each year. It helps you harness that amazing power of compounding, makes your money work harder for you over the long haul, regardless of the current economic vibe.
Good advice. Okay, for those of you planning summer trips, we found some interesting tips on traveling as a couple. Apparently, to minimize conflict, it's really crucial to set expectations, financial and experiential, before you even leave for vacation together.
Yeah, and this brings up a good question. How well do you really know how your partner handles travel problems? The inevitable hiccups.
Yeah.
Asking specific what-if questions beforehand can help, like, how do you feel about flight delays, or what would you do if your phone got stolen? It can help reveal how they cope before you're stuck in a chaotic airport layover somewhere. Think about Cecilia Mize's story from Chengdu. China unexpected delays really tested patience. Knowing how you both react ahead of time can save a ton of stress.
That makes sense. Setting boundaries on expectations for a smoother trip.
Exactly.
Okay, and for all you shoppers listening, Amazon Prime Day, it's running for 4 days this year. July 8th to the 11th. It's the first time it's ever been longer than 2 days. And there's this limited time offer for new Prime Visa members. A $250 Amazon gift card instantly when you get approved. No spending needed.
Yeah, that gift card alone, it more than covers the annual Prime membership fee for the first year. So it's pretty compelling if you're already shopping a lot on Amazon and thinking about Prime anyway. And during Prime Day itself, you can also get 7% back on eligible Amazon purchases if you choose no rush shipping. That's an interesting little perk. But if you want something more versatile, the Blue Cash Everyday Card from Amex gives 3% cash back on U.S. online retail, no annual fee. Or the Wells Fargo Active Cash Card gives a flat 2% back on everything. Options out there.
Good options. Finally, let's wrap with just a couple of fascinating developments in transport and tech that kind of hint at shifting norms. The TSA, they plan to let many travelers keep their shoes on at airport security, ending that rule from, 20 years ago? After the shoe bomber incident in 2001?
Yeah, the idea is to make the passenger experience better while keeping security strong. It kind of builds on the TSA pre-check program, where you can already keep your shoes on. It's a small change, but it's a significant tweak to that whole airport security experience we've gotten used to, redefining that boundary a little.
Yeah, definitely.
And then in autonomous vehicles, Waymo, which is owned by Alphabet, Google's parent company, they're now offering accounts for teenagers, ages 14 to 17, starting in Phoenix. That's a pretty big step, right? To boost ridership, help monetize their AI products. It pushes the boundary of who gets access to driverless tech.
Wow, 14-year-olds, how does that work?
Well, parents can invite their teens into the program. Waymo says they'll have specially trained support agents available during the rides. Teens can share their trip status with parents. Parents get the receipts. This move into a younger demographic really highlights how quickly this driverless tech is becoming mainstream and how it's changing our definition of personal mobility.
What a dense deep dive that was. We covered a lot, from the details of the big beautiful bill, the shifting sands of global trade, all the way to revenge savings and maybe easier future travel. We've really explored how boundaries are being redrawn, haven't we, across policy, markets, our daily lives.
Yes, exactly. And putting it all in context, it's just so clear that everything, government policy, market swings, tech advances, it all feeds into our daily lives, our financial decisions, often subtly changing the rules of the game.
So, as you look ahead through the rest of 2025, how will these redefinitions we talked about in taxes, market dynamics, personal finance strategies, how will they influence your approach? Maybe it's rethinking your savings plan now you know about vibe-based budgeting, or considering how shifting trade policies might affect your investments. Or maybe it's just planning your next trip with a deeper understanding of your partner's travel style. Definitely something to think about, what knowledge you gain today and how you can apply it to navigate your own path forward.